Okay, now we're going to do application 2-3, which is on page 47 in your textbook, and this is basically a continuation of 2-2. The first transaction is on March the 11th, and on this one we receive cash from sales. Now we're going to use the same accounts that we used for application 2-2, so refer to that chart of accounts. On March 11th, we received cash from sales. So the two accounts that we're going to be dealing with here are cash and sales. So our cash is going up and our sales are going up. Think of the sales as every time someone goes up to a cash register and buys something, that's a sale. So money's going into the cash register, so sales are going up. So the cash is going to increase by $2,200, and we're going to increase cash with a debit. And our sales are going to increase by $2,200, and we're going to increase our sales with a credit. And the next transaction is on March the 12th. And on this one, we paid cash for advertising. Now we're going to look at that chart of accounts on page 46. And we know that if we pay cash for advertising, we're going to use cash and advertising expense. So the two accounts we're dealing with here are cash and advertising expense. Now our cash is going down. That's advertising. And then expense, I'm going to abbreviate EXP. Our cash is going down, and it's going down by $150. We're going to decrease our cash with a credit. Our advertising expense is going up, so we're going to increase an expense with a debit. And if you have questions, refer to that sheet that I gave you guys that has the accounting equation, and it's kind of your cheat sheet to use to go along with these transactions. On March the 14th, we sold services on account to Dominic Field. Now, if you see those keywords, sold services, that's the same thing as sales. So if you see the term sold services, you know you're going to have the account sales affected. So we are going to go to sales, and then also we sold them on account to Dominic Field. So Dominic Field is going to owe us money. And when someone owes us money, that's an account receivable because we have a right to receive that money from them. So we're going to abbreviate that. AR stands for accounts receivable, and then we're going to write D Field for Dominic Field. Okay, so if we sold services on account to Dominic Field, we had sales. Our sales increased, and they increased by $1,700. So we're going to increase sales with a credit of $1,700. And the amount that Dominic Field owes us is going to increase by $1,700. We're going to increase an account receivable with a debit. So we're going to debit account receivable Dominic Field $1,700. On March the 18th, we paid cash to the owner for personal use. When you see that term personal use, you know that you're going to do something with the drawing account. So we're going to go to our chart of accounts, and the account we're going to use is Hal Rosen, drawing. So we paid cash to the owner for personal use. Our two accounts that we're going to deal with are going to be cash, because you see cash in the transaction, and Hal Rosen, which we're going to abbreviate HR, drawing. Now, the company's cash is going down, so we're going to decrease cash with a credit, and we're going to put $500 on the credit side, which is always the right side, $500, and we're going to debit the drawing account, because in order to increase the drawing account, we're going to debit it. So we're going to debit it $500. And our last transaction is on March the 19th. We received cash on account from Dominic Field. So now Dominic is paying us back some of the money that he owes us. So we received cash, so we know we're going to do something with cash. And Dominic is paying us back some money, so we know we're going to do something with that account that we have with him, account receivable. And the amount of money that he paid us back is $1,000. So our cash is going to increase by $1,000. We're going to increase that with a debit, and the balance that Dominic owes us is going to go down. So we're going to decrease Dominic's account with us by $1,000. So we're going to decrease that with a credit. And that is the last transaction on application 2-3 on page 47 in your textbook.